Have you had enough of seeing your stock picks fail miserably while others reap the rewards? To be honest, trading is about avoiding the correct mistakes rather than about luck. And believe me, even professionals have screwed these things out of hand. We are dissecting the main dangers today that most likely sink your gains faster than you could update your trading app. Therefore, stay around if you wish to trade smartly instead of succumbing to common traps, since there are mistakes you cannot afford to make. All set to change the script on your standard game? Let's start immediately. 1. Following trends. Starting with a common error made by many traders: following trends. You know that sensation when everyone starts talking about a hot stock all at once? It's all over the news, on social media, and perhaps even in friend talks. You begin to believe you have to buy before it's too late. That need to avoid losing out can cause you to leap in without thinking. The issue is that typically the largest gains are already passed by the time a stock starts trending. Purchasing it now could mean spending a lot of money, and if the stock value declines, you could lose a lot of cash. Pursuing trends is based on emotion rather than strategy, hence it hardly results in long-term success. The next mistake we will discuss can provide some recommendations if you wish to prevent those emotions connected with hype. 2. Neglecting a strategy. One major error rookie traders make is not having a clear strategy before beginning trade. Imagine yourself buying a stock you like, and then, now what? Without a strategy, one may easily get lost in uncertainty or base decisions on emotions rather than data. A trading plan should cover things like your desired stock holding period, price you are ready to sell it at, and how much you are ready to lose if things go wrong. Having these specifics organized provides you with a road plan to follow, avoiding the need for hunching over decisions under pressure. Wait until we discuss the next mistake, one that could seriously drain your account when you try to trade without defined restrictions. 3. Overtrading. Overtrading is among the most often occurring errors in trading. This is the situation where you keep buying and selling stocks excessively under the belief that additional trading will increase your income. The fact is, though, that every deal costs money, from taxes to fees and commissions. Little expenses pile up, and before you know it, a sizable portion of your profit has vanished. Stress and impaired judgment are other side effects of overtrading. It is easy to lose sight of your goal and base judgments on impulse when you are continuously observing the market and reacting to every little change. Did you want to gain insight into why some trades are best off left unaltered? The next error illustrates what happens when you follow emotions. 4. Letting emotions rule you. Letting emotions control you is one major mistake many traders make. Though it might be demanding, trading can be fascinating. One feels on top of the world when stocks rise, but when they fall, one may easily get startled or even annoyed. Making decisions based on these emotions might result in mistakes like hanging onto a stock for too long because you are hoping it will turn around, or selling too quickly because you are worried it might plummet further. Good trading is opposed by emotions, including greed and fear. Rather, even in an erratic market, it is advisable to follow your plan. Intrigued about how feelings could inspire other dangerous behavior? The next error delves into a habit that might silently undermine your long-term success. 5. Overwhelming risk trading. Another typical error traders make is taking on too much risk. It's easy to believe, maybe I can double my money too, when you read tales of people making large sums of money in the stock market. On the other hand, trying to go large too fast by betting on really dangerous stocks or investing a lot in one stock might backfire rather dramatically. High gains sometimes come with great dangers. Should things go south, you may lose a significant portion of your investment. Spreading your money around several stocks or kinds of investments will help you to balance risk. This means that you have other stocks to balance your account, even if one does not perform well. In a trade full of danger, though, how can one really make safe decisions? The following error relates to the reasons behind intelligent stock selection not being as straightforward as it first looks. 6. Not examining enough data. Many traders make a big error by starting trades without doing appropriate research. You are, however, trading blindly without knowing what the business does, how it generates money, or its future prospects. Researching a stock is investigating its financial situation, current performance, and future intentions. It enables you to base your decisions on facts rather than gossip or marketing. You are far less likely to act impulsively when you invest the time to comprehend a stock. Think of research as a dull activity? The next error could surprise you, since we discuss how missing one important step might cause you to be hanging at the worst conceivable moment. 7. Not considering an exit strategy. Not including an exit plan is the last error we are considering, and maybe one of the most crucial ones. You are effectively flying blind without a well-defined exit plan. Many new traders buy a stock and say, "I'll just wait until it makes me some money," but they neglect to create future plans. The exit strategy is an established plan designed to indicate when to sell a stock, either to limit losses or lock in earnings. This approach goes beyond simply understanding when to sell to include having a clear vision for your trades. What kind of profit? Before you turn off the water, how much loss are you ready to accept? Imagine your purchased stock is doing nicely, but you consider maybe it will go even more instead of selling when you reach your aim. The stock declines before you know it, so you pass on the opportunity to profitably sell. Your trading confidence may suffer, and the regret can be real. Conversely, having an exit plan helps you avoid panic selling as well. Having a predefined loss point will enable you to follow the strategy rather than responding emotionally and acting impulsively should the stock suddenly decline. Some traders decide to employ trailing stops, which, when the stock price rises, automatically modify your exit point. This enables you to lock in gains when the stock price rises without continual observation. Like a safety net, it lets you ride the waves as long as possible while catching you should things go bad. Please note that without an exit strategy, you run more danger than only financial loss. It may impair your long-term capacity for portfolio growth. As a stock market trader, I hope you found these pointers on the main errors to prevent useful. Which one error have you made on your trading path that you would want to concentrate on not moving forward? Drop your responses in the space provided for comments. Remember to like, subscribe, and share for more significant videos.